All right, guys, welcome back for another video. In today's video, I want to talk about the Bitcoin futures on CME and also the Bitcoin futures ETF called BITO, released last year on the New York Stock Exchange. I also want to talk about the Ethereum positive carry trade and tie this into Bitcoin futures. If you haven't seen the video titled Ethereum Staking Rewards, the positive carry trade, posted roughly 3 months ago, I really suggest you check that video out. It goes into more detail than I'm going to go into on this video, but we'll revisit that concept in a little bit. But first, I just want to talk about the effect that the cash settled futures market has on price. So if you look at, like, for example, the CME futures market, when it went live here, uh, the period where CME went live marked the exact top of the 2017 bull market. Now you can't see it here, but if you've been around Bitcoin for a while, you know the 2017 bull market topped out at 20,000. That's when CME went live. Remember, CME is a cash settled futures market. That means that CME is selling Bitcoin contracts that they don't actually hold the spot underlying Bitcoin. Um, you get that effect, and then that's your macro top right there. Same idea here. The BITO ETF went live, the first Bitcoin exchange traded fund within the United States. A lot of people got bullish at that. And it would have been very bullish had it been a spot ETF. But this is also a cash settled futures ETF that went live right here. And that also marks your macro top right there. Remember, the futures ETF is selling Bitcoin that they don't own. They don't own any spot underlying, so they can sell float that they don't actually possess. And then you get your macro top right there. Now, how does this tie into the Ethereum staking rewards? Well, first, I got to just basically outline what the Ethereum positive carry trade is and how people go about trading it, how it ties into the futures ETF. Well, essentially, the Ethereum positive carry trade is if you take Ethereum, stake Ethereum, and then you capture the yield on Ethereum's, and people speculate, it could be anywhere between 6 and 12%. We'll just use 9% for the sake of this argument. You've got your 9% Ethereum staking reward, and then you compare that to the cost of financing. Now, if you're financing uh, this staking endeavor in US dollars, your financing rate is going to be roughly around 5% or so. If you're doing it in other currencies where interest rates are lower, your financing rate is going to be much lower, right? It could be at 2 or 3%. It could be even lower than that. If you're in Japan, it could be 0.25%. It's hard to say exactly. So this trade will actually, probably be more appealing to foreigners at first, but ultimately interest rates will probably go down in the future in America, and then the positive carry trade will become even more appealing in the U.S. because essentially all you do is you take the Ethereum yield and subtract the cost of financing, and that's your positive spread. Now, of course, you need to go into the market and hedge your currency risk, which generally, when you're doing that in some type of bond market, it's going to cut into your return, right? So if you have a high yielding bond like Russian bonds or some sovereign debt that is considered, risky by the market, the reason why the yields are high is because its solvency risk is higher, right? The market demands higher yields for that debt. So you're naturally going to need to hedge that solvency risk, that currency risk. While in Ethereum, that means going into the cash settled futures markets and opening shorts. Now, this is a little bit different than kind of what we went into on CME and the futures ETF, in that in order to do a positive carry trade on Ethereum, you need to buy the spot underlying and stake the spot underlying, right? So that is a little bit different, right? That contributes to the new deflationary supply schedule of Ethereum post merge, in a way that people just selling futures ETF wouldn't have, right? So they need to go in, they need to buy spot underlying, and then they're going to go into the cash settled futures market to hedge their currency risk, but they probably won't hedge all the delta, right? They'll probably still be exposed in some regards. So in that effect, they'll want a little bit of exposure to Ethereum, especially if interest rates are going down and that positive carry trade is becoming more appealing, right? Because if interest rates go down, then Ethereum will probably go up relative to the dollar. Again, that's if the interest rates on the dollar go down, right? That's generally when you're probably going to see Ethereum start trading higher relative to the dollar and entering, depending on how significant the interest rate cuts are, you could enter a very, significant and prolonged secular bull market. At which point, if that happens, then the futures premiums across, various different futures durations are all basically going to trade in significant premium, which means that any investor doing the positive carry trade would essentially be getting paid to go in and hedge their currency risk, which is just totally different than what happens if you're doing a positive carry trade in the bond market, right? Bond investors go in order to hedge their currency risk, they got to pay a lot of out of their return to do that, right? It really cuts into their return. So this is kind of the scenario where it's not really playing out right now because interest rates are rising in America, right? Interest rates have gone up for the last few months and will probably continue to go up for a decent amount of time. Now, I do want to draw your attention to the DXY and kind of show that the DXY parabola has actually broken. So let's see if we can put an arc right here. Oh, not that. Let's see. Here we go. So there's your parabolic curve. You can also mark off the apex top right there. And we got a break kind of at the start of November, right? Basically, you don't have to get too cute with it. The idea is that the dollar currency index has broken its parabolic advance, right? One of the rules of every parabolic market is that they eventually all blow up, right? And we're seeing that break. Now, the way I interpret this is kind of through the lens of thinking as the market as a forward-looking instrument, meaning that the market is generally looking somewhere between 6 and 12 months out into the future. Why 6 and 12 months? Who knows? But that's generally also the same amount of time it takes for inflation to reach the market, roughly that 8-month time period. Why that is, who knows? But whenever a central bank prints a large amount of money, it takes time to change hands, right, and to circulate through the economy. First, benefiting those who printed it, and then benefiting, secondly, those who exchanged secondhand with the people who printed it, and so on, right? The people who are closest to that source of capital benefit the most as it's distributed out into the economy. That's called the Cantillon effect. It takes roughly 6 months to 12 months. And it's roughly about the same amount of period, same time period that the market is forward looking, right? If you start looking beyond 12 months, you start getting into even more exaggerated alpha because, less tends to be priced out that far on the horizon. Anyway, it's a long way of saying the way I interpret this is the market saying that interest rates will have peaked somewhere within that 6 to 12 month time period. So this is the market telling you a piece of information without, the Fed necessarily coming out and announcing that they're going to pivot, right? Because that hasn't happened yet. Remember, the market is forward looking. The market is suggesting that interest rates will have peaked within roughly 8 months, or by the end of the second quarter of next year, roughly. Of course, these are rough estimates, but you know, this is if you are massively bearish and you see this, maybe you've had a great run so far. Maybe you've been long dollar all the way from the bottom, short equities, maybe short Bitcoin. Uh, this is a good time to take your profits. When things turn around like this, take the money you've made out of the market, go on vacation, come back to the market with fresh eyes. Because a lot of times after a break of structure, things generally won't just collapse right away. Sometimes things will oscillate around, for weeks, even months, and just, continue to get market participants on the wrong side of the trade. But anyway, it's a long way of saying I do think interest rates are near their peak. And once interest rates start falling, then, the positive carry trade on Ethereum becomes even more appealing. And I think a lot of capital will flow into the market just because, there's not a lot of alpha left in the bond market, right? The average holding period for most bonds is roughly 28 days. So you don't have long-term capital in the market. You have, you know, bond traders and major banks with trading desks. They're trying to get in and out of trades and arbitrage. But the long-term capital is gone from the market. And ultimately, these big institutions, they need long-term capital structures, right? They can't, 28-day holding period is just not going to work, right? You need that long-term capital base that you can model into your projections. And Ethereum, I believe Ethereum will be a natural fit for bond investors to kind of gravitate towards because they naturally understand that yield. So I think when they see Ethereum and the yield that it offers, they'll naturally gravitate towards that, especially if we do get a bull market and futures premiums start trading pretty aggressively higher. And I think you'll see people come in and step in and start arbitraging that. Anyway, I hope you guys like this video. If you do like this content, make sure to leave a like on the video. Also, subscribe to the channel if you haven't already.